Here again with Smart System. In our last lesson, we looked at how the Fed enacts monetary policy by increasing and decreasing the money supply, and the effect this has on interest rates. In today's lesson, we're going to look at how the Fed is expected to react at different points in the business cycle, so we can anticipate how the markets are going to move as a result. So let's get started. As you hopefully remember from our previous lessons, the economy goes through periods of growth and contraction which tend to repeat over time. These movements are referred to as the business cycle, a chart of which you can see here. As we learned in our lesson on fiscal policy in the business cycle, the government tries to manage the business cycle with the goals of maximizing economic growth, employment and price stability. As we learned in our last lesson, the primary tool which the Fed uses from a monetary policy standpoint to manage the business cycle is targeting the Fed funds rate by increasing and decreasing the money supply. Now let's take a look at the business cycle and the balancing that the Fed must play and trying to keep the economic growth at its full potential, while at the same time sticking to its goal of price stability. During an expansion, employment is normally high and growing, which means lots of people are getting paychecks to spend on goods and services, and businesses are expanding to meet the growth in the economy. It's during this time that the balancing act the Fed must play between driving economic growth and keeping prices stable normally shift towards the keeping prices stable side of the equation. In the early stages of an expansion, the supply of goods and services can normally keep up with the demand, so prices remain in check. As the economy continues to heat up, however, situations can arise, like we are seeing now in the commodities markets, where demand is growing faster than supply, and therefore inflation begins to enter the picture. It's for this reason that, during the expansionary phase of the economic cycle, you will normally see the Fed become more concerned with keeping prices in check, without slowing economic growth too much. The way that they would do this is by reducing the money supply in order to slow economic growth, so that inflation does not get out of hand. As we learned in our last lesson, reductions in the money supply means increases in the Fed funds rate. And as we learned in previous lessons, increases in interest rates means slower economic growth, which normally means sell-off in the stock market, all else being equal. During a peak, employment is normally high, but the growth in employment starts to slow, and the growth in unemployment starts to rise. This means that growth and spending, and therefore economic growth, is leveling off and starting to turn downwards, as demand is moderating. This normally means that prices are also stable, which allows the Fed to shift its attention back to keeping economic growth going, and to avoid a potential contraction. With this in mind, during a potential peak in the business cycle, you normally see the Fed increase the money supply, the most to try and bolster demand, which means decreases in the Fed funds rate. As we've learned in previous lessons, decreases in interest rates means higher economic growth, which means stock market rallies, all else being equal. Although there are exceptions to this, which we learned about in our lesson on fiscal policy, during a contraction, price stability is not normally a concern, and therefore, the Fed's full attention is placed on economic growth. Very simply means the Fed will become more aggressive and increasing the supply of money, which means further reductions in the Fed funds rate, which means a pickup in economic growth, and stock market rallies, all else being equal. During a trough, interest rate cuts have started to filter through the economy, are working to push it back towards an expansionary period. During this time, the balance will normally begin to shift back towards price stability, and the posture of the Fed will normally be one of either inaction or a bias towards tightening. The money supply causing interest rates to rise. The reaction of markets in this case will generally depend on how quickly the Fed moves to raise interest rates and how quickly the economy is expected to emerge from the trough. One last thing to note here is that there is a lag between action by the Fed to increase or decrease the supply of money and seeing the intended effects on the economy. As a general rule, it takes 6 to 9 months to see changes in the money supply filter through and be reflected in the economy. So the Fed will often take monetary policy action in anticipation of future changes in the business cycle. That's our lesson for today. In our next lesson, we're going to look at how the Fed signals changes in monetary policy to the market before they are actually made, and how drastic market moves are expected to be under different circumstances. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section. And good luck with the trading. Have a great day.